The world you have gotten used to has permanently changed. And luckily for you, your Uncle Paul is here to tell you why that's a great thing for you as a long-term investor. Don't buy into the idea that that's a bad thing. It's a great thing for long-term and disciplined investors, and I'm here to tell you exactly why that is. All right, guys, CPI just came out this morning. Core CPI was exactly in line at 4.1%, and here is the CPI according to the Bureau of Labor Statistics. Now remember, core CPI takes out food and energy. It's the CPI it's the inflation number that the Fed is going to focus on. They exclude food and energy because of the volatility of them. And as you can see right here, all items less food and energy came in at 0.3%, which was expectation, and 4.1% for change for the year. Now, look at food and energy. Food changed 3.7%. Energy was down 0.5%. Now, overall came in at 3.7, which was higher than they were expecting. They were expecting 3.6, so the market has pulled back just a little bit. Guys, I cannot repeat till I'm blue in the face. We've become so accustomed to these low rates. But guys, we're actually not that high compared to history. Let's look at an example for the 30-year mortgage. That's something everybody focuses on. This is the 30-year mortgage going back to 1970 or 71. The overall average is 7.75. And as you can see, it includes a really high 16, 17%, 18% back in the early 80s, and as low as 2.5, 2.6% back in 2021, 2022. Those are very low rates, and these are very high rates. The overall average, still 7.75 going back 50 years. Now, my view on inflation and my view on rates is not typical of most people. I'm not here to be this fudster of saying, oh my God, there's so much fear. Guys, high rates weed out crap. When rates are very low, everybody out there is going to be able to borrow very cheaply, make a lot of investments, buy a lot of assets, and feel very, very smart and very, very rich. But that's not true investing. True investing is about being able to sit there and say, okay, is this a temporary issue or is this a permanent issue? The great thing is now you can park money on 90-day treasuries at 5.5%. So why is that a good thing? Well, it allows you to sit there and be more cautious and selective about your investments. If you can get 5.5% guaranteed by the US government over a yearly period, what kind of return do you need to get to invest in a stock? You obviously want to have a really good return. But when you're getting 0% before, that's what caused bubbles and that's what caused overvaluation. Because people sat there and said, listen, I'm only getting 0%. I'm getting 0% at my bank. I might as well go invest it in the S&P and at least get 1.5 or 2% dividend plus see my money grow. I love high rates because it gives me a reason to save. It gives me a reason to be more cautious. When you look at real estate prices, now forget about home prices, look at apartment buildings. You look at these things saying, okay, if I can sit there and get 0% in the bank, I might be okay making 4 or 5% on a real estate deal. That's terrible though. You want to be able to be paid for your risk. And it's always about what is your opportunity cost? What can you invest in alternatively than buying stocks and real estate? Putting money in savings. And when rates are higher, you get a higher return on that money in savings just parked there doing nothing with less risk. I love that aspect. Now, when it comes to inflation, some of the numbers that came in, housing costs came in higher. And that's a big chunk of the inflation number. And I believe, and a lot of people are in agreement with this, that the next Fed meeting, which is going to be October 31st and November 1st, there'll be an announcement of a higher 0.25%. I'm not making a bank on that. I'm just guessing here. There's no way I'm going to make any investing decisions any differently based on what I think the Fed is going to do. I love what Warren Buffett said. Warren Buffett said, if the Fed chair came to me and whispered in my ear what he was going to do for the next year or two on Fed policy, I wouldn't change my investing style. And I agree with that. Now I agree with that. I'm still buying some stocks. Am I buying a lot of stocks? No, I'm being very selective. I have 12 companies that in some of our videos I have mentioned that I own that I'm being selective. As their stock prices fall, as long as my fundamental thesis stays the same, I buy more of it. Markets are very overpriced, still based on history, 73, 75% overvalued. I love that because it allows me now with 5.5% on 90-day treasury to be even more selective. I can increase my requirement for returns on my equities. I can increase my requirement for returns on my real estate deals. And I believe that as rates stay higher and higher, that makes it better for everybody, especially savers. Now, Is it likely to hurt your portfolio? Yeah, probably over a long period of time. I still believe the next 10 years are not going to be great for stocks. The last 10 years were incredible. The next 10 years are likely to not be great based on the fact that we're so overvalued. But if you're a person who wants to sit in cash, if these 90-day treasuries stay at 5.5% to 6%, guys, that's pretty awesome. You're going to make 5.5% to 6% sitting in cash. That's an incredible, incredible return with very minimal, practically zero risk of losing any money. That's awesome. So why would you not embrace that? Well, because we have the idea of sitting there going, oh my God, my portfolio's down. Guys, inflation is the friend of long-term wage earners, long-term real estate holders. Inflation's okay. It's big inflation that we hate. When inflation was 10%, 9% a year and a half ago, that was scary because it takes a long time for wages to come up. And I don't blame anybody for that. But in the meantime, it's okay to have 3 or 4% inflation. And guess what? Inflation is here to stay. The more and more we print money, the more and more the Fed goes out there and prints that money. It makes us feel warm and fuzzy temporarily, but guys, there's a price to be paid for that. What's that price? Inflation. And that's okay. Then, to fight inflation, they raise rates. And what does that do? It gives you money right now in higher return through 90-day treasuries. You know, when you see inflation here at 3.7% overall, but you can put money in 90-day treasuries at 5.5%, even after paying taxes on that, you're keeping up with inflation. That's not bad. I love that. It's a great way to sit there and be conservative and wait for the right opportunities. When rates were 0%, it was the FOMO. Oh my God, I'm getting 0 here. I can get 2% here. And all of a sudden, everything felt even better. Well, is that really healthy? Come on, guys, that's not healthy. Now, we look back at this chart of the 30-year mortgage. Guys, there's so many people I know who sit there and say, well, you know, I'm going to buy this house, and when rates go back down to 4% or 3.5%, I'll refinance. Guys, going back 50 years, even going back 100 years, you cannot find rates that low for home prices. The 10-year average treasury was 4.4% going back to 1871. If the 10-year treasury is 4.4%, you can't borrow at 4.5% on your home mortgage. It's just way too difficult. So remember, there are cycles. The good news is this time right here, early 80s, things were tough. Late 70s, things were tough. Inflation was rampant. People were losing jobs, 10.5% unemployment. And over time, from the storm comes the good days. And we had a 40-year bull run in treasuries. It had to end at some point. You can't sit there and have 10-year treasuries at 1.5 to 1.6, 1.7% for long periods of time and be okay with it. Look at Japan. Japan's 10-year treasury just hit 0.8%. But look at the issues Japan has economically. They haven't had good economic growth in a long, long time. Their stock market, the Nikkei, hit a high of near 40,000 back in 1989. It has not seen that level since. That's a 35-year market in which the values have not reached those levels since then. We want to be a growing economy. We want to be an economy that adds people, adds productive people, adds good wage earners, and sees people's home prices go up steadily, not these massive fluctuations. So I'm here to tell you guys, news is just news. How you interpret it, I look at a stock market being down 50% and I get excited. Somebody else might look at it and say, that's terrible. The same event, and we're looking at different ways. Which way would you rather look at it? My guess is you probably want to look at it the way I do, which is an opportunity. And that takes more than just understanding the numbers. It takes being around like-minded people like me to be able to explain to you all these things in a positive light. So guys, if you like this video, you like what I'm saying, I just need you something very easy for me. Like the video, subscribe to the channel. And before we go, I want to drop a few more nuggets for you. Used car prices have been plummeting. Remember 2 years ago, a year ago, you couldn't buy used car prices were skyrocketing. It was crazy. Even if you wanted to buy a new car, you had to pay above. It was insane. Well, those prices are coming down now. And there's a lot of hope that those used car prices will really drive down inflation. Now, over the last year, real wage growth. That means wage growth above and beyond inflation. So has increased 0.5% according to the Labor Department. That's an increase of 0.5% above inflation. Now, in the recent short term, it's been trailing. But remember, wages take a little bit of time to catch up to inflation. It's not going to happen immediate. It has to happen over some time. So I like the fact that real wages are up 0.5%. Guys, if you look at our history, Over long periods of time, real wages have done well. And for everybody in the economy, does it take a little bit longer? Absolutely. But just remember this the next time you hope the government writes checks. No, there's no such thing as free money. You have to sit there every single time the government writes a check and gives money to people, there will be a cost all across the board. It's going to affect everyone, some people more than others. Just remember that your Uncle Paul here is here to explain it to you in a rational and non-scary way.